So good evening, good afternoon, or good morning, depending on when you are. It's my pleasure to welcome you to this e-Access Forum webinar. Today we will depart somewhat from financial and monetary policy to touch upon also fiscal policy. And this will allow us to discuss what I think is a very important issue, which is the coordination of fiscal and monetary policy in the context of climate change. Policy coordination is very important because, as we have argued several times in these webinars, addressing climate change and supporting the transition request the implementation of a comprehensive policy package, not just one single policy, and all policy levels must pull on the same rope and to support the transition to a low carbon and climate resilience economy, the transition that we need soon. So today we are going to see how carbon tax, carbon subsidies, and central bank asset purchases can be combined, or how do they interplay. And for that, it's my pleasure to welcome Alessandro Notarpietro, who will present a paper that he wrote with Anna Bartocci and Massimiliano Pisani, all from the Bank of Italy, if I'm not mistaken. Welcome, Alessandro. A quick introduction. Alessandro is head of the Models for Policy Analysis Unit in the Modeling and Forecasting Division at the Bank of Italy. He has been in this position since 2022, if I'm right, and he joined the Bank of Italy in 2008. Starting as an economist in the Economic Outlook and Monetary Policy Directorate. During his time at the Banca d'Italia, he has also visited the Department of Economics of New York University, so in the Stern School of Business. And he was co-lead of the Eurosystem workstream on Eurosystem modeling for the work related to the strategic review of the ECB monetary policy strategy. So Alessandro, correct me if I said something wrong, but before giving you the floor, let me ask you the two usual questions that we ask in the beginning of the seminar, if we can put them up on the screen. So they are related to the presentation today. The first question is, do you think that carbon tax revenues should fund subsidies for renewable source of energy, cut in labor taxes, both, or they should not be linked to any specific use? And second question, if carbon tax is introduced with a disinflationary effect and the interest rate is at its effective lower bound, then the central bank should, for monetary policy purpose, purchase sovereign bonds to mitigate the disinflationary effect, use longer refinancing operation for the same reason, not use any non-standard monetary policy, or suggest waiting for the implementation of the carbon tax to avoid this disinflationary effect. So only one answer allowed by questions. I give you a few seconds more because it's kind of difficult questions. So not obvious, and I hope that I know that the paper of Alessandro has answers to them, so we will see what they are, or tentative answers. So let's see what the results are, if we can. Okay, so clearly they should be linked to both subsidies and cutting labor taxes. And for the second question, interestingly, there is a majority for using longer-term refinancing operation instead of asset purchases, but still action from on a non-standard monetary policy by central banks. So I guess this is something that could be interesting to discuss for you at the end of this presentation, because this is not directly the topic of your presentation, Alessandro. But that being said, let me give you the floor, and just to remind the audience that you can ask questions in the Q&A session, in the Q&A box, and I will relay them at the end of the session. Yeah, Alessandro, the floor is yours.
Thanks a lot. Thanks a lot, Pierre, for this very kind introduction. And thanks for having me today. It's a great pleasure. Thanks to the organizers. It's great to be part of this webinar series. So let me see if I can share my screen, and then we are ready to go.
Yeah, it's still not full screen for me, but
yeah. Is it? Is it now?
Yes, yes, it is. Perfect.
Great, fantastic. So thanks a lot. As I said, it's great to be in this webinar series, and thanks for having us. Yes, this is joint work, as you said, Pierre, correctly. Everything you said was correct, by the way. This is joint work with Anna Bartocci and Massimiliano Pisani, who are also at the Bank of Italy, and the usual disclaimer applies here. So whatever I'm going to say should not be attributed to the Bank of Italy. So what we do in the paper is we try and evaluate the macroeconomic effects of what we label green fiscal policy measures in the euro area. So the focus is on the euro area. And what we mean by green fiscal policy is first and foremost a carbon tax, that is a tax on the use of fossil fuels. Now, this may be accompanied possibly by subsidies to renewable sources of energy and lower labor income tax. And that's sort of an answer to the first question in the poll, but I'll get back to that more precisely during the talk. And we also look at the interactions of these fiscal policy measures with monetary policy. About the motivation, I guess I don't really have to spend much time convincing you that action is needed clearly on the climate front. And there are, as we all know, European targets that have been set. And the first one is in 2030 about reduction in CO2 emissions. So that's a fact. And that's a starting point that motivates our research question. And carbon taxes specifically have always been, for a long time, been considered as key measures to reduce CO2 emissions. As I will say during the talk, some measures are already in place. And so what we are going to consider is a carbon tax on top of all the fiscal measures, and at industry level, sector level, country level, that can be more or less effective in achieving this objective of reducing CO2 emissions. So this is broadly what we do and why we do it. So during the talk, I will start by defining more precisely our contribution and trying to frame it in the literature. And I'll give you a preview of the main results. Then I'll give a sketch of the model setup and the structure without going too much into the details and trying to focus on what's the novel part of our framework. Then I'll talk a little bit about the calibration and walk you through the simulated scenarios, illustrate the result, and conclude. So our contribution from a methodological point of view is we use a large-scale New Keynesian model that is calibrated to the euro area and the rest of the world. And there are two main elements, two main features. Let me focus on the first one. That's the second bullet, because that's the novel, relatively novel part of our model. So in the model, energy production comes from different sources, namely oil, coal, and gas. Those are the traditional or the fossil fuel sources, and all of these emit CO2. So not surprisingly, they will be subject to the carbon tax. We also allow for nuclear and for renewable or green source of energy. That's representative of solar, bio, wind, hydro, and so on. So that's the first and most relevant part, especially for the subject of the talk, and that's about the energy production in the model. And I'll show you a little more details about how this is implemented. Another important element in the model is financial market segmentation, which we take sort of off the shelf from this work by Chen and co-authors, which is by now one of the most representative contributions. And financial market segmentation, in terms of imperfect substitutability among financial assets, allows non-standard monetary policy measures, such as central bank asset purchases of long-term sovereign bonds, to have real effects. That part will be motivated by the fact that we study at some point the interaction, as I said in the very beginning, of these fiscal measures with monetary policy, and we do so in a framework which allows for an effective lower bound. And I'll motivate why we do this and why and how monetary policy is implemented in the model. Okay, so the related literature is I would say it's growing by the minute. And in fact, if you have been following workshops and webinars and conferences, both live, online, and in person, you'll see that there's an incredibly growing number of contributions. So in this slide here, we're just reporting a very non-exhaustive list of contribution that share with us pretty much the framework in terms of using a dynamic general equilibrium model. So we start with this contribution that's well known with Sargent and co-authors, but most recently we have seen works by the European Commission and other colleagues. Some of this has been presented in this webinar too. All of this have in common the use of general equilibrium models that allow for the study of carbon taxes and other measures that are aimed at reducing CO2 emissions. I would say not surprisingly, as we have scant empirical evidence so far, there are empirical studies, but we definitely need model-based simulations to analyze this type of interventions. Okay, so very briefly, a preview of the results, and then I'll walk you through the model first. So what we're going to show is that a carbon tax can generates recessionary effects, and these costs can be alleviated by a combination of subsidies to the use of renewable sources and lower labor income tax. In particular, if these measures are implemented when the interest rate is close to the lower bound and when the lower bound starts binding, there is an amplification effect. So the disinflationary or deflationary effects are amplified, and we can actually observe larger costs. At that point, we show that if the central bank, for monetary policy purposes, namely to achieve its inflation target, implements non-standard measures in the form of long-term sovereign bond purchases, then these negative amplification effects can be offset. The ones related to the ELB can be offset. So these are our main conclusions and contributions. In the paper, we also provide some robustness and sensitivity analysis, but these are really the main takeaway. So here is a slide in which we try to provide a graphic representation of the model, or better said, of the most relevant part of the model for our analysis. The model, as I said, is a New Keynesian one. So there's some features that are standard that I will not deal with in this presentation. And the model also allows for heterogeneity on the household sector. As I said, there is financial market segmentation. So some households are going to be investing only in long-term bonds and physical capital, while other households have larger access to financial markets. And we also allowed for hand-to-mouth or rule-of-thumb consumers. But let me now focus on the less standard or the novel part of the model, that is the production of energy. So I will go top down here and start with the intermediate sector. So that's the New Keynesian sort of standard layer. And we have firms in the intermediate goods sector working under monopolistic competition and producing imperfect substitutable goods. So these goods are going to be assembled into final goods, that is a public consumption good and a private consumption good and investment. How do we produce these intermediate goods? We need capital and labor and energy. So firms are going to produce using capital, labor, and energy. And households are also going to consume energy. So you should think of this as being gasoline or heating and so on. And therefore, at both the household level and the firm's level, there's going to be a demand for energy. So this energy bundle here is going to be assembled using energy produced out of 5 different sources, actually. So to the left, we have the ones using fossil fuels. So energy is produced out of coal, oil, gas, but also out of renewables and out of nuclear. The structure that we impose here, it's a very simple one and is in line with other contributions in the literature. So these sectors here operate under perfect competition. And what they do is they use a CES, that is a constant relativity substitution production function, in which there are capital, labor, and a specific source of energy. So in the sector that produces energy out of coal, you're going to be needing coal, capital, and labor to produce energy. Same thing for oil, for gas, renewable sources, nuclear, and so on. One crucial parameter, as I will come back to in a few minutes, is the weight of these different production factors and the elasticity of substitution among them. In Another important parameter is the substitutability of these different energy goods produced out of different sources into the final bundle that is demanded by firms and by households. And another important element is the substitutability of this energy with capital and labor, or the substitutability of this energy in the weight of this energy in the consumption model. So this is our structure as far as energy production is concerned. So again, standard New Keynesian setup, monopolistic competition. Goods are produced out of capital, labor, and energy, but there's also a component of energy demand coming from households. How is this energy produced? In 5 different sectors, which are imperfectly substitutable. And each of those sectors has the same structure, so it produces energy out of a specific source, capital, and labor. Okay, so having said that, let me walk you through the calibration. For simplicity, we assume that the euro area and the rest of the world are rather symmetric, but of course, for the size, the degree of openness, and imports. Specifically, the Eurozone is going to be importing coal, oil, and gas from the rest of the world. So the rest of the world has an endowment of these fossil fuels and of these sources, and the Eurozone is importing this from the rest of the world. There is no market for renewables and no market for nuclear. So this is what's imported as far as energy is concerned. In terms of calibration, as I said, there are key parameters that concern the energy sector. So in line with the literature, we assume a relatively low degree of substitution between energy and non-energy consumption goods. That is this part here. We also assume that there is a relatively low substitution between value-added and energy inputs in manufacturing production. That is, it's a relatively low degree of substitution, or if you will, capital, labor, and energy are rather complements than substitutes when it comes to producing the intermediate goods. And we also assume a relatively low substitutability between the source and then capital and labor in energy generation. That is this part here, this part of the model. And we do this pretty much in line with the literature. But since there is a lot of uncertainty around these parameter values, and since these are key parameters in the transmission, as I will illustrate commenting on the simulations, we run sensitivity on this. And in particular, we run sensitivity on the elasticity of substitution among different types of energy, and on the weights of fossil fuels in the energy generating technology. So the weight of this and this and this component in this production function. And we show that results are robust. So our conclusions are robust to altering this value within a plausible range of values for the parameters. Okay, so having said that about the calibration, let me now describe first how we construct the different scenarios and then show you the results. The first scenario we consider is the introduction of a carbon tax, or an increase in carbon tax in the Eurozone. As I already said, this should be thought of as something that is on top of measures that already exist, such as ETS or other fiscal measures that apply to some specific sectors, industry, countries, and so on. So there's an increase in the taxation of fossil fuel in the Eurozone. So the use of oil, coal, and gas is going to be taxed, whereas the use of nuclear and renewables is not going to be taxed. In the second scenario, we are going to consider a fiscal package in a way, or a combination that is ex-ante budget neutral, and that's a key point. So from an ex-ante perspective, the increase in tax revenues related to the carbon tax is used to do the following things: to subsidize the use of renewable sources and to reduce labor tax. And we consider the introduction of this green fiscal policy mix and see what difference it makes. And then we redo the same scenario, we reanalyze the same scenario in the presence of a lower bound. And finally, we also consider central bank asset purchases. Now, before I walk you through the simulations, let me just spend a couple of words motivating why, especially we consider point 3 and point 4. Well, when we started this project about a year ago or so, the lower bound was more of a concern, especially in the euro area, than it might be now. And in fact, back then it made sense to consider the possible proximity of the nominal interest rate to its effective lower bound. You may argue that this is less the case today, considering the current situation. Now, that's absolutely correct. One thing that's to be kept in mind, though, is that if we consider this from a medium-term perspective, we should keep an eye on estimates for the natural rate of interest, which is what ultimately defines for a given level of inflation target level that the nominal rate presumably will oscillate around. And as a matter of fact, recent estimates of the real interest rate still point toward very low values. And those historical trends and secular forces that seems to have been in place in the past decades seem to be still at play. So it's still reasonable, although there's a lot of uncertainty, not surprisingly, given the large shocks that we have witnessed in the past 3 years or so. But it makes sense to consider that the natural rate will presumably stay low for a while. So that justifies the study of the lower bound as a possible constraint of monetary policy. And finally, about the last bullet, let me just mention, as I said before, that this is just the case in which the central bank, for monetary policy purposes, is running these non-standard measures. So there's no direct link with the carbon tax or with the fiscal policy itself, just to be clear. And finally, let me also mention that from a technical point of view, we are considering both the carbon tax and the fiscal measures, but also the monetary policy measures are fully anticipated and fully credible. So there's an announcement in the beginning, everybody believes that announcement, everybody thinks it's credible, and everything is implemented smoothly. So in other words, we're technically working on the perfect foresight hypothesis, and there is no uncertainty except for the first period. Okay, so let's start with the first scenario. The increase in taxation is something we take from a recent work by the IMF in a fiscal monitor in 2019. They quantify in an increase in $75 over 9 years. They quantify an increase in $75. They motivate that this is sufficient to guarantee a sufficient reduction in CO2 emissions. Now, we don't really model CO2 emissions. We don't take a stand on that, or we just take this value and we don't argue whether exposed this is actually sufficient to achieve the CO2 emission targets, reduction targets. So we calibrate the carbon tax in this way, and it's a gradual increase over 9 years. And again, this is in line with the numbers reported by the IMF. And again, this is announced and it's fully credible and it's gradual. So there's no, just to be clear, there is no connection, for instance, with the recent increase in energy prices that we have witnessed, that we are witnessing these days. So this is really a completely different framework, both from a conceptual point of view and from a policy implementation point of view. Okay, so what happens in terms of transmission in the model is the following thing. So the carbon tax applies to oil, coal, and gas-based energy production. So here I'm reporting optimal oil demand for the case of energy produced out of oil, but you should really think of this as applying exactly the same way to coal and gas. So this is the weight of the oil source in production, and this is the elasticity of substitution. This is the energy produced out of oil. This is real marginal cost, and this is the price of oil. The carbon tax is going to be increasing production costs, other things equal. So a higher carbon tax is going to imply lower demand for oil in energy production, but also lower demand for coal and gas in just about the same way. So this slide reports the effects of the increase in the carbon tax on the main variables. As you can see, there's a gradual fall in GDP. These are quarters on the horizontal axis, so this is 10 years really. And as you see, GDP falls, although in a gradual way. And the interesting thing is headline inflation mildly falls. And then after about 7-8 years, it actually grows above its steady state level and picks up a bit. So the interesting thing is there are two different forces, the different channels at play. So energy inflation is increasing, and that's because energy production out of fossil fuels is directly hit by the carbon tax, and that's increasing production, and that's increasing production costs in that sector. So that's what motivates this increase. At the same time, though, there is, because it's more costly to produce out of those sources, there's a lower demand for those sources, but given the low substitution among coal or oil or gas and capital and labor, this is also reducing demand for those production factors. At the same time, there is some substitution in the sense that energy should be produced using renewables and nuclear, but given the relatively low substitutability across different types of energy, this effect is not completely compensating for the fall in demand. So overall, we observe a fall in aggregate demand because of this falling capital and labor demand. So aggregate demand is falling, and that's what's driving this falling manufacturing goods inflation. And overall, we see a falling headline inflation that's reflecting the operation of this fall in aggregate demand. And again, this also reflects the fact that this announcement is fully credible. So everybody's factoring in this increase in the carbon tax over time. As a result, the monetary policy rate is reduced in order to stabilize inflation and output. What we are, I haven't said it, so let me just mention it briefly. There is a standard Taylor rule in the model. And so the policy rate responds to deviation of inflation from its target and to output growth. And since inflation is falling and output is falling too, then the monetary policy rate is falling, although by a relatively small amount. Okay, so in the second scenario, we are going to assume that the increase in tax revenues, which in this case is just rebated in a lump sum way to recurrent households, is instead used in the following way. There's an ex-ante budget neutral fiscal policy mix, which accompanies the increase in the carbon tax with an increase in subsidies to the use of renewable sources and lower labor taxation. Let me also mention that this is meant to be illustrative and suggestive. We do not take a stand on whether this is optimal, for instance. So our analysis is purely positive. There is no optimal combination of different policy measures here. And by no means this is an exhaustive list of possible measures that can be implemented. So this is our, and we thought it would be interesting to consider these measures because it helps particularly illustrating the channels at play in this case. Okay, so when we do this and we engineer this ex-ante budget neutral fiscal policy mix, the combination of these different measures imply the following thing. So first, before I show the results, let me just show how this, in particular, the subsidy enters the model. The labor tax deduction is pretty standard. That's just a lower labor tax paid by households. And because some households are hand to mouth, this is having a particular impact on consumption. But the way subsidies enter the model is the following. So energy production based on renewables is going to be affected in the following way. The government is actually subsidizing investment in physical capital. So this is the same expression as before. This is just the weight of capital in the production function. Again, is this the substitution, real marginal cost, and our case, the rental rate of capital. So the government is basically subsidizing and it's paying the rental rate of capital for firms. So in other words, the higher the subsidy, the higher the demand for capital in the renewable sector. These are the results in the case of implementation of this green fiscal policy mix. So the first result that stands out is that the falling GDP is not there anymore, at least in the first 4 or 5 or 6 years. And then it gradually falls, but by a very limited amount compared to the case of a carbon tax implemented in isolation. The second result is inflation is still falling, although by a smaller amount. Now, what's happening here is the following thing. On the one hand, there is a carbon tax, which has the same transmission that I have illustrated before. And in fact, inflation in the energy sector is still increasing. At the same time, though, the fall in aggregate demand is somehow compensated for by two factors. First, there is a lower labor tax that is paid by households, and therefore there is an increase in aggregate demand by just as a direct effect. And at the same time, the renewable sector, there is a larger demand for capital, which, given the complementarity between capital, labor, and energy, is also implying a higher demand for the other production factors. This is sustaining aggregate demand. So to some extent, there's a larger demand also in the other energy sectors. And therefore, aggregate demand increases, and that's what sustains price dynamics. And in fact, in aggregate, in equilibrium, inflation is falling by a smaller amount in the manufacturing sector and overall. The monetary policy rate, as a result, falls by a smaller amount. Now, as I said, we extend this analysis to the case in which we allow the effective lower bound to be a constraint on monetary policy. And the way we technically do this is by applying the max operator to the standard Taylor rule, which is another way to say that we endogenize the lower bound. So in other words, when we implement, and I'm just going to show you the case of green fiscal policy mix first implicitly, but we could have done the same, and we actually did the same for the carbon tax in isolation. So let me just focus on the black line here. When we redo the same exercise, assuming that the lower bound can be a constraint, and so the monetary policy rate cannot necessarily fall by as much as needed to stabilize inflation, this is what's happening. So let me start with the monetary policy rate here. The black line is the same scenario that I've shown before, and the red one is the one with an effective lower bound. So as you see, our effective lower bound is, for technical reasons, set at -20 or a little more than -20 basis points. So once it reaches that level, the monetary policy rate cannot fall any further. And what typically happens in this case, this is the classical amplification channel related to the lower bound, is the real rate is increasing because inflation falls, but the monetary policy rate cannot fall by as much. And increasing the real rate is dampening aggregate demand. And in fact, in the short term, the fall in GDP is largely amplified, and the same holds true for inflation. And you can see both in the manufacturing sector and in the energy sector. And this again reflects the larger fall in aggregate demand, which by now is is much more pronounced than it was in the previous case. And if you look at the last chart here, you have long-term sovereign bond interest rates increasing. That's just because exposed the fiscal measure turns out to be imply a fall in GDP. So government debt is expanding, the supply is expanding, and the price falling, and the interest rate, the long-term interest rate is increasing, and in the case of the ELB, it's increasing by a larger amount. Okay, so as a last scenario, we consider what happens if, in this case, in the red dash line here, when this fiscal policy measure is implemented in the proximity of the lower bound. So when the lower bound actually amplifies the effects and a larger cost materialize in GDP and inflation, what happens if the central bank, for monetary policy purposes, implements non-standard measures? So as I said, this is not a direct response to the fiscal measures, but it's just what monetary policy does to achieve its own target, that is price stability. And let me also mention that these asset purchases are purely discretional. They don't follow any systematic rules such as a Taylor rule, but they are just announced and implemented smoothly. In particular, we're going to assume here that the central bank announces the purchase of an amount of bonds that is about a little less than 4% of annualized euro area GDP. And in historical terms, it's not particularly large. The first announcement in January 2015 was about 10%. So this is relatively small compared to that announcement, but that's just, again, an illustrative example. So the green line here reports the case in which the green fiscal policy mix is implemented, the lower bound holds, but at the same time, the central bank announces these asset purchases. Now, the transmission of this additional layer is rather standard. When the central bank steps in, intervenes, and buys long-term bonds, the price of those bonds increases and the long-term rate decreases. And those agents that are constrained and can only invest in long-term bonds or in physical capital are going to substitute the former with the latter. So they basically increase investment, and aggregate demand is sustained. That sustains consumption too, and price dynamics. That's the usual transmission of this type of interventions. As a result, we are going to observe actually an expansion in GDP because of this large sustained to aggregate demand. In this case, GDP increases, but the point really is that this fall is not there anymore. And price dynamics is sustained too. So the fall in inflation is much smaller. And the real interest rate is following, is actually stabilizing at the level, is falling compared to the previous case. So in relative terms, it's falling. Okay, so this these are the main results. Maybe I'll spend a couple of minutes talking about the sensitivity. So just to wrap up on the main conclusions, the carbon tax has negative effects in GDP and mildly deflationary effects when it's implemented in isolations, and when the increase in tax revenues is just rebated in a lump sum fashion. So this is the cleanest result we could provide. Then when we combine this carbon tax with in an ex-ante budget neutral way with subsidies to green energy and lower labor income tax, we actually show that the macroeconomic cost can be limited by a large amount. And in fact, GDP doesn't quite fall anymore, although these inflationary or deflationary effects are still there. The lower bound, though, can actually imply costs, even in this instance here, even though in this case, in principle, we should not observe large costs in terms of GDP or no costs at all for a few years. We may still observe costs if these measures are implemented when the ELB is close by. And in this case, we have shown that if monetary policy, because of its own, for its own purposes, is implementing non-standard measures, then this cost can be reduced. Now, in the final minute or a couple of minutes before I stop, let me just show a few sensitivity analyses that we performed. As I mentioned, we run sensitivity on the elasticity of substitution among different types of energy and on the weight of fossil fuels in energy generating technologies. Our results are robust. Let me show you what happens when we increase the elasticity of substitution among energy sources. What this means is that whenever we, for instance, in this case, I'm showing the case of a green fiscal policy mix. In that case, what happens is that, as I said, one of the reasons why we observed this fall in aggregate demand was that it is not possible to completely substitute one form of energy production with another one. And in fact, when we increase the elasticity of substitution, we observe a little difference in the sense that GDP is more stable, it increases by less and it falls by less, but results are robust. And the same is true when we increase the weight of fossil fuels in production. And finally, an interesting case that is worth mentioning is that the speed of implementation matters too. So in the results that I've shown, the implementation is over 9 years and it's gradual. When we assume that implementation is still gradual, but it's over 5 years, so it's faster, then we actually observe a qualitatively similar result. But the interesting thing is that the cost in GDP is more pronounced, the fall in GDP is more pronounced, and inflation initially falls, but then starts picking up sooner. But that's simply reflecting the faster carbon tax increase. So I'm gonna stop here and thank you for your patience, and I am ready to and happy to take questions if there is any. Thank you.
Thanks a lot, Alessandro. So let me remind the audience that you can ask your question in the Q&A box. Please do. And before turning to the question of the audience, a few questions on my side. The first one is, I mean, you said that this is a kind of a positive study in that you choose a scenario that you want, and you introduce in particular reducing labor tax. Why did you choose this in particular, and do you think it would change anything if you have chosen another tax to be reduced, a tax on investment or on profits? Does that really matters for the results? Is that basically the reduction in taxes that matters, or the type of taxes that is reduced? I don't know if you have some hints from your.
Shall I reply now? And
sure, yeah.
Sure. No, thanks a lot. That's a very interesting question. So yes, it's really a positive study. So there's no, in no sense, this is an optimal combination. We chose this. So the second part of your question was, would it make any difference if it was another reduction in another tax rate? I'm not sure we tried with, I should go back and check, but I'm not sure we tried with the reduction in taxation on profits or on capital. I expect results not to change dramatically. So one thing that characterizes the reduction in labor income tax in this model is because we have these different households. Some of them are hand to mouth. So in that case, the reduction is more powerful because the marginal propensity to consume is larger. So in that case, in that sense, the result may be quantitatively affected by this choice. But in general, the reduction in, for instance, taxation on capital income should work pretty much in the same way. And the point is you're basically reducing taxation on one of the production factors. So it could be labor, it could be capital, but I expect on average results not to change qualitatively, at least if we were to do that. I think one reason that I mentioned to choose labor is because of the transmission, because of this heterogeneity. Another one is that it's probably conceptually quite different from the case of a subsidy to investment. If we were to, but I'm just speculating and guessing here, if we were to use reduced taxation on capital income, then the channels would probably a little bit overlap with the case of a subsidy to renewable sources, but that would be sector specific. So if we were to do this across the board, then we would still see some difference. So I think qualitatively we would probably have similar results, but maybe quantitatively there would be small differences depending on the calibration.
I mean, that allows me to highlight one particularity of your model that I think very interesting is the heterogeneous agent that you have, and the fact that you can also maybe look at the different impact on, hand-to-mouth low-income people and high-income people that also have like income from interest rate. Mm-hmm. Did you run some simulation on these two, or estimation on these two types of agents? I mean, can you see something about how inequality evolves, for example, in the different case?
So one thing we are considering now is we are looking at the effects of targeted transfers. That's one thing that's been discussed this day a lot, although it's not related to our experiment. But in the case of energy price shocks, one thing that's often discussed these days is the use of targeted transfers to those that are more vulnerable or more severely hit by the shock. So one thing we are experimenting with is targeted transfers. So that's interesting because it provides, but it's really a work in progress. So I can provide more specific and quantitative results. But yes, that's one channel that we are considering. So in fact, targeted transfers seem to be having an impact, especially on consumption of different agents, and that's so aggregate demand is changing also depending on how these transfers are designed and targeted. Yes.
I mean, just to rebound that one thing that we know about large-scale asset purchases is that they tend to increase inequality, at least in the beginning, until they have an impact on unemployment. Mm-hmm. Would that be also the case in this scenario, or that in a scenario of ELB and asset purchases?
We haven't really looked at that specifically, but let me also say that it's true we have this heterogeneity, although it's a very stylized one. We have this, about, if I'm not mistaken, 55% of the households are just Ricardian and unrestricted, and the rest is divided into restricted and rule of thumb. But it's a very stark composition, and it's fixed. So if we really wanted to have a more detailed analysis of the distributional effects, we should probably have a completely different setup in which the shares are moving over time in response to the shocks, which we don't have here. So yeah, that's probably the main issue.
One more question on my side. You said in the beginning that you have like perfect foresight for the agent. Do you have a sense of how uncertainty in expectations there would affect the result of the model, or you think there are also robust to some uncertainty?
No, that's a great question. So one thing we did as a robustness check is we consider the case in which, say, in the initial part, the announcement is not like fully credible, for instance. And what we did is we assumed that, say, in the first year, we assume this is a gradual implementation over 9 years. Okay, so we assume that in the first year, agents are continuously surprised by the announcement. So in other words, you could rationalize this as being an announcement that is not fully credible, or maybe is not fully implemented for some reason. In that case, when agents are initially surprised, then the transmission changes a little bit. So the initial effect is not as large, and then the initial negative effect on inflation is not there anymore, because the large effect through aggregate demand is not at play in that case. So because agents do not foresee the whole future adjustment in the carbon tax, they don't. The aggregate demand channel is not as powerful, and so what prevails on prices is actually the direct effect of the carbon tax. And so in that case, the result is less, is changing a little bit, at least qualitatively. So the disinflationary effects in the beginning is not there because of this. But then eventually, when agents, in a sense, in a very loose sense, learn, or when everything is clarified and they have full knowledge of the future adjustment, then the same adjustment that we are showing here is actually in place. But that's a key factor. So if we allow for some uncertainty, so to speak, in the beginning, then this is something that may make a difference on the transmission. Yes, absolutely. Thanks a lot.
One more question from the chat. Actually, part of one question. So you suggest, so you look at the implication of a carbon tax. If we would have like a quantity cap or higher bound for the use of fossil fuel, that's really changing the setup of your model. But do you see any big difference, like immediately, that it would make, or would you need to rebuild your model entirely
Well, the model would have to be changed quite heavily. I mean, we would probably need to have, I don't know, something like a completely different production function, I guess. Hard to speculate on that. Yeah, I think no, I think, yeah, we would definitely need to have a completely different setup in which you can only use let's say the fossil fuel up to some extent, and then you're not allowed to use it anymore. So that's like an extreme assumption on the substitutability in a way. And so I could probably argue that if you take the case of an extremely low substitution across factors, in our case, in the current setup, you may probably go in that direction. And so probably there's an even stronger amplification of the negative effects. But it's really something that's worth looking at from a modeling perspective. Yes.
Okay, there are two big questions coming, or elephant in the room. The first one from my side is on regarding the answer to the question we had at the beginning, and using refinancing operations instead of asset purchases. So I guess that would also would push you to rebuild the model. But would that also be, you think, a possible alternative, or would it change the results in that way?
So no, yeah, I knew this would come up. I hadn't forgotten about that. I was about to mention. No, that's a very good point. Yes, we would need to have banks to make room for a meaningful implementation of long-term refinancing operations. We would need to have banks, and we would need to have some details about the way loans are provided to firms, basically. So what that would imply is a different transmission mechanism of non-standard measure. So in our case, as I alluded to in the presentation, what happens is the transmission of central bank asset purchases is via the imperfect substitution of assets. So if there's some guy out there who can only invest in long-term bonds or in physical capital, for whatever reason, you think of pension funds or other institutions out there that might be forced to only invest in long-term bonds. And if that's the case, this imperfect substitution operates through investment, basically. And that's the first part, and the one that's most responsive within aggregate demand, and that's responsible for the sustained to aggregate demand and to prices that we have seen. Now, in the case of long-term refinancing operation, we would need to have banks, and we would need to have this channel through which, again, it's investment that adjusts, but because of different reasons. So basically, we would have something that's probably closer to the case of a subsidy, in the sense that because banks provide loans to firms at certain condition during this implementation, then investment would be relatively cheaper for firms. And again, you would probably have a transmission on aggregate demand that's again going through investment. Although from a quantitative point of view, it's hard to say. You really need to have a competing model and compare the results. But in terms of transmission, I think the component that would respond the most would probably still investment, although because of different reasons. Yes.
Now, you mentioned in the beginning that you started this study 1 year ago when the world was different. Any implication from your model or the results of your model that you could extrapolate to a high inflation, high energy price world like today? Or
so, as I said, this is a very, very different setup. I mean, one thing that could be done is we could, and we are actually doing it in a different way, in a separate study. But one could study the effects of an energy price shock that's coming from a completely different source. As I said, this is a very different scenario, in the sense that this is not an exogenous shocks that's related to a modeled reasons. I mean, this is a policy intervention that is announced, is gradual, is fully credible, and so on. And as I said, answering to your question before, when that's not the case, at least in the beginning part of the implementation, then things could change. So these factors are key. And the one thing we can learn from this simulation is that when this is not the case, that when there is no announcement of the full path of energy prices in the future because of the tax or because of whatever other reason, and when there is large uncertainty, then that's going to make a big difference. So if we were to extrapolate anything that relates to the current situation, I would probably say that uncertainty is what matters the most in that case. And energy price shocks being surrounded by large uncertainty means that the different channels at play through demand and supply are hard to disentangle, and it's hard to tell ex ante which one is going to prevail because of this large uncertainty. But again, this is a very, very different setup and scenario in which policy decisions are announced ex ante, they're gradual, and there is no huge spike in the price of energy due to unforeseen reasons, such as in the case that we're witnessing now. Although it's also the case that persistence is an issue in the case of the current juncture, because the shock was unprecedented, but it was also, but it's also unclear what the persistence is going to be. So that's yet another layer of complexity. And as I said, uncertainty about the persistence seems to be a very relevant channel to play also in our case.
One last question from the Q&A about, I can try to rephrase it in terms of what is in your model. What is the impact of higher carbon tax on the interest rate or the rate of return of investment? Because we could think of a situation where a higher carbon tax actually shift, so makes investment in carbon companies too expensive, and the shift investment to other sectors that have a higher interest rate, maybe riskier, but at least a higher interest rate.
Mm-hmm.
Do you account for that, or do you see that in your model?
Yeah, as I said, what happens in the case of the carbon tax, you have a higher production costs in those three sectors: oil, coal, and gas, that are directly hit by the tax. Now that's reducing demand for labor, capital, and fossil fuel sources in those sectors. And to the extent that you can substitute with renewables or other source or nuclear in our case, but let's say green, broadly speaking, then this is increasing demand for capital in those sectors. So there is some recomposition effect. Now, the quantitative issue is how easy it is or how hard it is to subsidize. And then that's one thing that we try to take into account. And then I also showed in the sensitivity when I showed what happens when you change the elasticity. Another issue which we don't touch in the model and in the paper, but it's definitely relevant, is you could actually have technology improvements in some sectors. So what we do in our scenario is we have R&D subsidies. We have subsidies to physical capital investment in one sector. So again, in terms of investing in capital, we are trying to facilitate this switch from, let's say, brown to green sector in a way, because the government is subsidizing physical capital investment in those sectors. Now, one thing we don't consider, but it's definitely worth looking at, is what happens if you have subsidies to, let's say, R&D activity in some sectors, in renewables. And for instance, if we had a model with, say, endogenous growth, where endogenous growth is driven basically by R&D investment, then one natural experiment to do would be, okay, what happens if the government is implementing the carbon tax, so it's taxing fossil fuels use, but at the same time, it's subsidizing R&D investment in, say, green technologies. That's expanding the frontier, so that's going to have a positive effect, and it's going to be an engine of growth in the long run. So, yes, that could be changing the scenario quite significantly. Yes, but we don't do that here.
So we coming close to the hour. Thank you very much, Alessandro, for your presentation and for answering the question. Before we part, let me give the audience a head up for the special webinar that we will have on December 12. As you may know, EAccess is giving a prize for outstanding research in the field of central banks and climate change. And on December 12, we will announce the winner of this year prize. And we will invite the winner to join a panel with a prize selection committee, which it will be Fernanda Necchio, Patrick Bolton, Glenn Rudabush, and Steve Cecchetti, and myself, if I remember well. And then with this panel, we would like to discuss the milestone of climate economic research that we have had this year, as well as the avenue of research for next year. So December 12 is definitely that date to mark on your agenda. And we are looking forward to seeing you join this unique event and celebrate the prize winner. So see you on the 12th. Thanks again, Alessandro.
Thank you.
And
thanks for having me.
And have a good end of evening or day, depending on where you are. Thank you.
Thank you. Bye.